In this video, I'm going to walk you through the number one biggest risk you face as a bond investor. And by the way, it's probably not what you think. Hey everybody, I'm James Knoll, founder of Root Financial Partners, and I'm here to teach you how to create a secure retirement. When you're an investor, you have a lot of investments that you can choose from, one of which is owning bonds. Now, bonds are facing one of the worst starts to the year that they've ever had in their entire history. And what I want to walk through is what is your greatest risk as a bond investor? Many people think it's rising rates. Other people think it's the risk of corporate or government default. It's neither of those. Let me illustrate exactly what I mean. Let's assume that you as an investor, you have a dollar that you want to invest, and you're wondering where should you put that dollar? Well, if we take this, and if we say, here's a dollar that you have to invest, how would that dollar have returned, or how would it have performed given different types of investments you could have chosen? And you know what, let's go way back to 1926, just to see over long periods of time how that dollar would have performed had you invested it in different things. Well, if you had invested that dollar in, say, the S&P 500, your return would have been about 10.5% since 1926. So $1 in the S&P 500, growing, you're not touching it for a long period of time, you returned an average of about 10.5%. Now, what if instead of owning the S&P 500, or instead of owning stocks, you had owned long-term government bonds? Well, your return on that, it wouldn't have been 10.5%, it would have been about 5.6%. So a little more than half of what it would have been returning had it been invested in the S&P 500. Now, if we take it a step further and say, what if it's not long-term government bonds, but it's short-term, so 30-day US Treasury bills, your return on that would have been 3.3%. So we look at these returns and it doesn't seem that dramatically different. Okay, you could invest in stocks and get a 10.5% return. You could invest in long-term government bonds and get a 5.6% return, or you could invest in short-term government bonds and get a 3.3% return. Doesn't seem that striking of a difference until you understand how compounding works. If we look at this and we say, okay, what if we had invested that single dollar in the S&P 500 and grown by 10.5% per year over this time period? Well, that single dollar would have turned into about $14,000 by the end of 2021. A pretty staggering return. Now, what if you invested that in long-term government bonds? You got about half of the annual return. Does that mean you ended up with about half of the dollars? Not even close. $1 invested in long-term government bonds, that would have grown to about $194 over that same time period. Significantly fewer dollars than that dollar that was invested into the S&P 500. Now let's look at Treasury bills. $1 invested in Treasury bills grew by 3.3%, which means your $1 would have grown to about $22. So you can notice a pretty significant difference between all these here. Now there's a trade-off for that. When you look at the S&P 500, it wasn't just a consistent 10.5% return year by year by year. It looked more like this. You had a lot of ups and a lot of downs, and this is where you ended up. Where you look at long-term government bonds, you had some ups and downs, but maybe not as many as the S&P 500, and there's where you ended up. In the Treasury bills, UST bills, there's never been a year where it's had a negative return over this time period, so a pretty consistent period or a pretty consistent performance, but you ended up with a lot fewer dollars. So that's the trade-off. But this is the difference of what you can expect, and this isn't even the worst of it. What we also have to factor in is that inflation over this time period. So this is about a 95-year time period that we're looking at when we look through the end of 2021. Inflation averaged about 2.9% when you look at the consumer price index. So it's not just what were our returns as investors, it's what were our real returns. If we look at our real returns, when we look at T-bills here, that had a very consistent performance year over year after year, well, that $22, when you look at real returns, is closer to $1.39, meaning $1 turned into $1.39 over 95 years of real returns. As investors, this is your greatest risk. As investors, your greatest risk is inflation increasing and you not being able to maintain your purchasing power throughout retirement. So yes, with the S&P 500, we walked through the fact that it looks more like this when you look at the returns. In these times here, these seem scary, and in fact, we're in the midst of one as we speak, but these always pass. What we need to make sure we're focused on is how do we maintain our purchasing power as investors over time knowing that inflation is going to continue going up. So this is not to say invest all of your money in stocks. This is not to say don't have anything in bonds. What it is to say is we need to understand and we need to reframe how we think about risk. If we look at risk as the diminishing of your purchasing power, we can start to understand how some of these investments here don't do a whole lot to maintain that purchasing power. They can help to protect when times are bad, but in your portfolio, there's no such thing as no risk. You're either taking your risk in the short term, like we're looking at here with investments in the stock market, or we're kicking that risk down the road and we're taking it in the long term when we look at $1 turning into $1.39 in UST bills over time. If you're watching this and you want to know how you can create a successful investment portfolio during retirement, be sure to check out this playlist above. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.